In the darkest days of World War II, the Axis powers seemed unstoppable, and behind their war machine was the Enigma, a sophisticated communication device that encrypted messages. Many believed its code was impossible to break. Enter Alan Turing and Gordon Welchman. These two brilliant mathematicians led Project Ultra, who did what many thought to be impossible. They broke the Enigma code. That they broke the code changed the course of World War II, but how they broke the code changed the course of history forever. They created what was known as the Bombay machine. The Bombay demonstrated that machines could simulate human thought processes, an idea at the very core of computing and artificial intelligence. Artificial intelligence, or AI, takes enormous amounts of information and then learns from it. For example, your phone likely has facial recognition software, which allows it to recognize whether you or someone else is trying to access your phone. Artificial intelligence technology has been around for many years, but it's become the #1 headline in the markets over the last couple of years, thanks to OpenAI's ChatGPT, which was launched at the end of November 2022. What ChatGPT introduced to the public was generative AI. Generative AI takes information and creates something new out of what it already knows. For example, the AI takes its knowledge of both dragons and football to come up with a new creation. The potential impact of this technology on the economy is profound. Initial research shows that employees who use AI to assist them in their workflows are 66% more productive. That is equivalent to roughly 47 years worth of normal productivity gains. Since OpenAI introduced ChatGPT in November 2022, NVIDIA, which makes the chips needed to run generative AI programs, has jumped 368%. NVIDIA has benefited the most from artificial intelligence, but it's certainly not alone. The so-called Magnificent Seven, which includes Microsoft, Apple, Amazon, Meta, Alphabet, and Tesla, have increased by an average of 127% in just 15 months. But what's unique about these 7 stocks is not just the amount that they've increased, but the impact that they've had on the overall stock market. Most stock indices like the S&P 500 and NASDAQ are weighted by a company's market cap. So the larger a company is, the bigger the weighting it gets in the index. And these 7 stocks make up 29% of the S&P 500. The impact of this on overall market performance has been significant. To illustrate, consider the performance of the market cap weighted S&P 500 versus the equal weighted S&P 500. While these indices both own the exact same stocks, the performance since November 2022 has been significantly different. The market cap weighted version of the S&P is up 27.8% compared to just 13.2% for the equal weighted version. The performance on the growth index has been even more substantial. The difference between the market cap weighted growth and the equal weighted growth is 19.3%. The market cap weighted version of the S&P Value Index is up 12.5% compared to 10.6% for the equal weighted. There's also a huge disparity between so-called growth stocks and value stocks. Growth stocks tend to be companies who are growing faster than average. Value stocks, on the other hand, tend to have higher earnings relative to their market values. This category of company also tends to include higher dividend yielding stocks, which our cornerstone and income builder strategies tend to hold. Our Sequoia and Capital Builder strategies, on the other hand, tend to be more growth-focused strategies. The S&P 500 Growth Index has outperformed the S&P 500 Value Index by a whopping 26.1% since November 2022. So what are we to make of this extraordinary gap between growth and value? Some market commentators have compared the current market to the late 1990s technology bubble, in which the stock prices of technology stocks got way ahead of their fundamentals, ultimately forming a bubble that came crashing down in 2000, 2001, and 2002. Leading up to that market crash, then Fed Chairman Alan Greenspan gave a speech where he famously said, "But how do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions as they have in Japan over the past decade?" While Greenspan was about 3.5 years early in his prediction, what he suggested ultimately came true. The euphoria surrounding technology stocks drove those companies up to unrealistically high valuations, particularly for companies that had no earnings and in some cases very few revenues. Between 1995 and 2000, the technology-led NASDAQ index increased by 800%. Unfortunately, things did not end well for technology investors. The NASDAQ index declined by nearly 80% from top to bottom. The dot-com bubble is a painful reminder of what happens when investors get euphoric about a particular idea. The internet did revolutionize the world, yet all of those companies were still poor investments, and the reason was their starting valuation was too high. Instead of the internet, you now have artificial intelligence, and just like it was back in the 1990s, you have unbelievable price increases for these technology companies. So are we in a bubble like we were in the late 1990s? We don't think so, at least not yet. So while Nvidia and other stock prices have increased significantly, they have the underlying profits and revenues to back up that increase. The market is certainly exuberant about the prospects for AI, but that exuberance, at least currently, appears to be rational. And if you compare today to the late 1990s, stocks look downright cheap. At the start of 2000, the forward earnings yield, which is simply the price to earnings flipped upside down, that yield was less than 0.5% higher than the real inflation-adjusted 10-year Treasury yield. So in other words, bonds were more attractive relative to stocks than they had been at any point since 1990 and at any point since. Today, however, the gap between the S&P 500 earnings yield and the real 10-year US Treasury yield is roughly 2.5%. In order for the relative valuation of stocks and bonds to be equal, the S&P 500 price would need to almost double from around 5,200 to 10,000. If the prices were to increase that much without a commensurate increase in earnings power, we would call that a bubble. As we go forward over the next couple of years, we believe that the real opportunities in the market are not necessarily going to be with the enablers of AI, but with the users of AI. As the rest of the economy and the rest of the companies in the S&P 500 begin to use artificial intelligence, we're likely to see profits and output increase while inflationary pressures should decrease. That should support a robust economy, as we've seen, is likely to reduce inflationary pressures, and with the Fed apparently on the sidelines, no longer aggressively raising interest rates, the conditions are right for the bull market to continue. Rational exuberance is certainly here for the Magnificent Seven, and we think the other 493 stocks in the S&P 500 could be next. If you have any questions, concerns, or comments, feel free to reach out to your portfolio manager. If you're not a client and you're interested in finding out more about our investment philosophy, you can send us an email or give us a phone call. One of our advisors would love to talk to you more about how we can help you reach your financial goals. Thanks for watching, and we'll see you in the next video.